And the bond market is starting to sniff this out. The yield on a 30-year U.S. Treasury today rose above 4.9%. We're at 4.92%. The yield on a 10-year is 4.69. So these are the highest yields that we've had since the Fed started cutting rates. You know, by the way, oil prices are now above $74 a barrel. They've been consistently rising over the past several weeks, as are a lot of other commodity prices. You know, this is an amazing thing. And I posted this chart on X. But if you look at the CRB index, commodity prices, today it's at a 14-year high, 14 years. And in the last 7 months, we're up over 28% in commodity prices. And that's in dollars. They're up more in euros. They're up more in Canadian dollars. Dollar's been strong. So commodity prices are surging all over the world, right? In Europe, they're up over 30%. You know, Christine Lagarde had a Twitter or an X post. She had a little video of herself. She's head of the ECB. And she greeted everybody by saying, 2025 is going to be a great year. This is the year inflation is coming back down to 2%. I mean, what is she smoking? It's first of all, it's about 3% now, but it's headed in the other direction. Prices are surging all around the world. Yes, we had a pullback in commodity prices as the Fed was initially tightening, but that's reversed. And again, we've had strong commodity prices, even with a strong dollar. So imagine how much stronger they're going to be when the dollar weakens, which eventually it is going to turn down. And, you know, this is despite oil. We're at a 14-year high. So oil has been a lot higher than $74 a barrel in the last 14 years. It's been well above 100. So oil is one of the bright spots in this dark cloud here of prices. Other commodity prices. Look at coffee prices, right? Look at sugar. Look at cocoa, right? And other grains are starting to move. Look at soybeans. Look at corn. All these food items. Everything is surging in price. At the same time, the Fed and the ECB, they're all saying, hey, we've won the inflation battle. We just want to make extra sure that we're down to 2%. They're not even close. And the bond market is starting to sniff this out. The yield on a 30-year U.S. Treasury today rose above 4.9%. We're at 4.92%. The yield on a 10-year is 4.69. So these are the highest yields that we've had since the Fed started cutting rates. In fact, you have to go back even further than that. But again, this does not surprise me. This is exactly what I was saying was going to happen even before the Fed started cutting. But I said that when the Fed did cut, but we are moving substantially higher. You know, mortgage rates now are back above 7% and rising. They're going to be above 8% pretty soon for a 30-year fixed rate mortgage. But they're back above 7. Credit card rates are what, 25%. They're going to keep going up. Now, we got more bad news. I mean, forget about the fact that the mainstream media is ignoring this boom in commodity prices. I mean, which is completely inconsistent with the story the Fed is trying to sell. How can they be telling us that inflation is going to come down when prices are soaring? And these commodities, these are input costs. So they're going to bleed in to producer prices and consumer prices, right? They're going to move first. And then you're going to see it going, you know, up the chain. So these are leading indicators. So how could you ignore? You know, the last time we started to see commodity prices surging like this, it was before inflation really ran away. And then in the face of it, the Fed was still claiming that inflation was transitory, even though commodity prices were showing that that wasn't the case. Well, that's happening again. Now they're saying that, you know, inflation's gone and commodities are surging. They are the result of the inflation. that is already there. The Fed never put out the entire time. And now you're seeing it in these commodity prices. You're going to see it more in oil. Again, one of the reasons that we didn't have a bigger move up in oil when Biden was president, and he's still president for a few more weeks, was his politically motivated decision to raid the Strategic Petroleum Reserve. Imagine where oil prices would have gone or might be now had we never, let loose all that oil. I mean, we didn't have to drill, baby, drill. We just tapped. We just sold the oil that we already had. But that card has been played. Trump is not going to do that, and so we're not going to get artificially low oil prices. Now, some people think, well, we're going to drill more oil, maybe, but not until the prices are a lot higher, because American oil companies are not going to invest in development and more capex for more drilling at $74 oil. They're just not going to do it. It's not high enough, But yes, if oil is back above 100 and it looks like it's going higher, and yeah, we'll probably get some more drilling. But that's not the environment that people expect. Everybody is talking about $40 oil. Well, at $40, no one's drilling oil, despite the fact that they're ignoring commodity prices. And I don't see anybody talking about it. They couldn't ignore the economic data that came out today. There was a big jump in prices paid in the PMI. It was the ISM Services Index, which was higher than expected. It was one of the only economic data points that was above expectations, although we did get jolts today that was above. But it was at 54.1. But the prices paid spiked up, highest level in 2 years. Obviously, there's a lot of inflationary pressures that have been building, and that spooked the bond market, together with the JOLTS numbers that showed a spike above 8 million in the job openings. And I think part of that has to do with optimism. There is a lot of misplaced optimism among businesses that things are going to get better because we have Trump. Now, that's going to fade relatively quickly once Trump becomes president and things don't get better. In fact, at his press conference again today, Donald Trump again reiterated how things are going to immediately get better. He said it's going to be right away. We're going to have this instant boom, right? Everything's going to magically get better when he's president. That's not going to happen. And when it doesn't happen, then a lot of these job openings may disappear because the businesses are going to lose more workers. So are going to be very disappointed as the data, especially when it comes to inflation and the Fed rate cuts. Now, the probability of rate cuts declined today after the release of this hotter than expected inflation number. And as soon as it came out, gold, which was up about $25, sold off, and it still ended up, positive about 13, 14 bucks on the day. The dollar, which was down this morning, and actually had a big pop yesterday, the dollar rallied. I'll get into that after the break on why the dollar rallied. But the dollar sold off as soon as this hotter than expected inflation numbers came out. But it's not just the inflation numbers themselves that caused the dollar to rally, but it was the reaction in the bond market where the bonds were hitting new lows for the year on this news, and that increase in bond yields is propping up the dollar. But that's not good for the dollar. The currency traders still don't get what's happening. They're still of the opinion that hotter than expected inflation just means the Fed has to fight hard, bullish for the dollar. Well, that's not what it indicates. I've been saying this all along. It doesn't indicate that the Fed has to fight harder to win. It indicates that the Fed has already lost. Inflation won the war. And this is not bullish for the dollar. Inflation is going to keep getting worse. Yes, it may slow down the rate cuts, but the Fed is not going to hike. Even though it never should have cut rates, all 100 basis points were a mistake. They're not going to be able to correct the mistake, because to do that, they're going to look so foolish if they have to do that. But But not only do they have to take away all 100 basis points, they need to have rates significantly higher than where they were when they started cutting. There's no way the Fed is going to do that. The only thing they're going to do is slow down the cuts. I can't see Powell hiking rates at all, even though he should. But he may not cut. But that's not bullish for the dollar, because if inflation keeps getting worse, and so instead of 2 or 3% inflation that people were expecting, we get 5 or 6 or 7% inflation, and the Fed just keeps rates where they are, that means a huge reduction in real rates. And that is very negative for the dollar, and that is very bullish for gold. And traders just haven't connected the dots yet. As I said earlier, that in order to get much lower inflation, we have to have structural changes. Americans have to save a lot more and spend a lot less, but we already have an economy that's built on excess consumption. The GDP is powered by spending money. Well, if you save the money, then you can't spend it, and you have to save it to build the factories, right? If we're not going to get the Japanese savings, we got to generate our own. Well, we can't save and spend the same money. So in order to rebuild our manufacturing infrastructure, we have to have a severe recession in the process, because we have to stop spending money so that we can use it to make these investments. And so we have to make those changes. But again, those are not the changes that are coming, because those are changes that are going to result in a short-term decline in how we measure the economy. So things have to get worse before they can get better. So I still think that I've got this thing handicapped correctly, that we're going to see an explosion in the price of gold and silver. The dollar's share of global reserves hit a new low, and what's replacing it is gold. And the central banks, I'm sure, gold. And so, we should be doing it. Take advantage of the $50 special at Schiff Gold. But I think these gold mining stocks, which went way down last year as a result of a huge sell-off post-election, the markets have got this completely wrong when it comes to the outlook for gold company profits. We should be loading up on these gold mining stocks. We should be buying the emerging markets. The emerging markets are not going to suffer from the Trump tariffs. To the extent that the tariffs are imposed, it will end up being a relief. Remember, contrary to what Donald Trump claims, we're not propping up the world. The world is propping up us. We do need their products. What they don't need is our fiat currency. They have the ability to print their own money, right? We don't have the ability to make our own products. Printing money is easy. Just run it off the presses. You don't even have to run off a press. You just create it out of thin air, right? So any government can create currency. They don't need ours. But producing real goods, that requires real capital, real labor, real infrastructure, right? Real resources that we don't have. And so Trump has it backwards. The world supports us, not the other way around. And he's about to learn this lesson the hard way.